Hello everyone, welcome to the 207th episode of Be Learning How to Trade in Forex. So in the last episode we went through Forex leverage, a double-edged sword. So leverage involves borrowing a certain amount of money needed to invest in something. The greater the amount of leverage of the capital you apply, the higher the risk that you'll assume. High leverage can quickly deplete your account if a trade goes against you. Now we're on to Forex basic setting up account. So let's get started then. Foreign exchange, Forex or FX, trading consists of buying and selling world currencies, and the marketplace is among the most liquid in the world. Forex trading is unique because individual investors can compete with large hedge funds and banks. They just need to set up the right account. There are three main types of trading accounts: standard, mini and managed, and each has its own advantages and disadvantages. Which type of account is right for you depends on your tolerance for risk, the size of your initial investment, and the amount of time you have to trade on a daily basis. So, three main types of trading accounts: standard, mini, and managed. Which type of account depends on your tolerance for risk, the size of your initial investment, and the amount of time you have to trade on a daily basis. Key takeaways: if you start to trade in Forex markets, you need to choose what type of account is best suited to your skill, knowledge, and experience. The most common is standard account with 100 to 1 leverage and standard lots up to $100,000 in notional value. Mini accounts reduce the maximum lot size to $10,000 and are intended for beginners, more risk-averse traders, or those with limited funds. For those who would rather have a professional portfolio manager to make your trades, a managed account might be worth the additional fees. So standard trading accounts. The standard trading account is the most common. This account gives the user access to standard lots of currency, each worth $100,000. That does not mean that you have to put down $100,000 of capital in order to trade. The rules of margin leverage, typically 100 to 1 in Forex, mean that only 1,000 needs to be in the margin account for one standard lot to be traded. Standard trading accounts gives the user access to standard lots of currency, each worth 100,000. The pros service: because a standard account requires adequate upfront capital to trade full lots, most brokers provide more services and better perks for individual investors who have this type of account. Gain potential: with each pip worth $10, if a position moves with you by 100 pips in one day, the gain will be $1,000. This type of gain is not possible with any other account type unless more than one standard lot is traded. The cons: capital requirement: most brokers require standard accounts to have a starting minimum balance of at least $2,000 and sometimes $5,000 to $10,000. Loss potential: just as you have the opportunity to gain 1,000 position moves with you, you can lose 1,000 in a 100 pip move against you. This loss could be devastating to an inexperienced trader with just the minimum in an account. This type of account is recommended for experienced, well-funded traders. So, pros of standard trading accounts: most brokers provide more services and better perks for this type of account. Gain potential: high gain potential. The cons of standard trading accounts: capital requirements: a decent amount of capital is needed to open the account. Loss potential: so high loss potential as well. This type of account is recommended for experienced, well-funded traders. Recommended for experienced and well-funded traders. Mini trading accounts. A mini trading account is simply a trading account that allows the traders to make transactions using mini lots. In most brokerage accounts, a mini lot is equal to $10,000, or 1/10 of a standard account. Trading accounts gives the user the ability to make transactions using mini lots, which is $10,000. Most brokers offering standard accounts will also offer mini accounts as a way to bring in new clients who are hesitant to trade full lots because of the investment required. So, pros of mini trading accounts. Low risk. By trading in 10,000 increments, inexperienced traders can trade without blowing through an account, and experienced traders can test new strategies without risking too much capital. Low risk as can trade without blowing through your capital. Low capital requirements. Most mini accounts can be opened with $250 to $500, and they come with a leverage of up to 400 to 1. Low capital requirement. Cons of mini trading accounts. Oh, flexibility as well. The key to successful trading is having a risk management plan and sticking to it. With mini lots, this is a lot easier to do because if one standard lot is too risky, you can buy 5 or 6 mini lots and minimize your risk. You can buy 5 or 6 mini lots and minimize your risk. Okay, fairs. So cons of mini trading accounts. Low reward. With low risk comes low reward. Mini accounts that trade $10,000 lot can only produce $1 per pip of movement as opposed to $10 in a standard account. This type of account is recommended for beginner forex traders or those looking to dabble with new strategies. Low potential reward. Micro accounts, a sister account to the mini, are also available through some online brokers. These accounts trade in 1,000 lots and have pip movements worth 10 cents per point. These accounts are typically used for investors with limited foreign exchange knowledge and can be opened for as little as $25. So Forex lot sizes: standard lot 1 lot 100,000, mini lot 10,000, micro lot 1,000, and nano lots 100. Managed trading accounts. So was it recommended for recommended for beginner traders or those looking to try out new strategies. Managed trading accounts. So managed trading accounts are forex accounts in which the capital is yours, but the decision to buy and sell are not. So an account where the capital is yours, but the decision to buy and sell are not. But the decisions to buy and sell are not. Account managers handle the account just as stockbrokers handle a managed stock account, where you set the objectives, profit goals, risk management, and the managers work to meet them. There are two types of managed accounts. Pooled funds, your money is put into a mutual fund with that of the other investors and the profits are shared. These accounts are categorized according to risk tolerance. A trader looking for higher returns will put their money into a pooled account that has higher risk reward ratio, while a trader looking to steady income will do the opposite. Read the fund's prospectus before investing. Individual accounts. Broker will handle each account individually, making decisions for each investor instead of the combined pool. Two types of managed trading accounts. So we've got pooled funds. So your money is put into a mutual fund with other investors and the profits are shared. Ensure to read the fund's prospectus before investing. Individual accounts. So individual accounts. Broker will handle each account individually, making decisions for each investor instead of the combined pool. So the broker will handle each account individually instead. Individually that'll do. The pros of managed trading accounts. Having a professional forex trader handle an account is an advantage that cannot be overstated. Also, if you want to diversify your portfolio without spending all day watching the market, this is the great choice. Professional guidance. That's it. The cons of managed trading accounts. Price. Be aware that most managed accounts will require a minimum 2,000 investment for pooled accounts and 10,000 for individual accounts. On top of this, account managers will keep a commission called an account maintenance fee, which is calculated per month or per year. Need a decent amount of capital funded. The account managers will also keep a commission called the account maintenance fee, which is calculated per month or per year. Flexibility. If you see the market moving, you won't have the flexibility to place a position. Instead, you have to rely on the account manager to make the right choice. This type of managed account is recommended for investors with high capital and no time or interest to follow the market. You'll have to rely on the account manager to make the right trading choice. This type of managed account, so recommended for investors with and no time or interest to follow the market. How much capital do I need to open a Forex trading account? To begin Forex trading, many brokers require at least $1,000 of capital transferred to your account. Although some discount brokers allow you to open a nano account for as little as $100. How do Forex brokers make money? If you have a Forex account, your broker can make money from charging trading commissions or by charging a spread, or both. Some brokers may also charge a monthly account fee for services like software interfaces or access to special trading products such as exotic options. Managed account providers may instead charge a fee based on the amount of assets under management. Is Forex trading risky? Major currency pairs tend to be very liquid with tight markets and do not often exhibit the same volatility as seen with stocks. Still, Forex trading can become risky due to the large amount of leverage margin afforded to currencies. This can range from 50 to 1 to 400 to 1 or higher. This means that for every $1 you have in your account, you can purchase $400 worth of currencies. This can amplify both profit and losses. The bottom line, no matter what account type you choose, it's wise to take a test drive first. Most brokers offer demo accounts which give investors an opportunity to use an account risk-free and try out different platforms and services. As a basic rule of thumb, never put money into an account unless you are completely satisfied with the investment being made. With the different options available for Forex trading accounts, the difference between being profitable and ending up on the red may be as simple as choosing the right type of accounts. Never put money into your account unless you're completely satisfied. With the investment being made. Cool, that's that done then. So on to the next one. We're done, we're on the current one. Next up, spot currencies. Spot exchange rate definition, how it works and how to trade. What is a spot exchange rate? A spot exchange rate is the current price at which a person can exchange one currency for another at a specified time. So the spot exchange rate is the current price at which a person can exchange one currency for another at a specified time. At a specific time. That's not how I spell it, but there we go. Put simply, a spot exchange rate refers to the cost of the currency exchanged instantly and without delay. Spot exchange rates are used for delivery on the earliest possible value date. Cash delivery for spot currency transactions is usually the standard settlement date of 2 business days after the transaction date. These exchange rates are set and governed by the foreign exchange market. Key takeaways: the spot exchange rate is the current market price for exchanging one currency for another. The spot rate is generally set by the Forex market. Some countries actively set or influence spot exchange rates through mechanisms like a currency peg. Currency traders follow spot rates to identify trading opportunities not only in the spot market but also in the futures, forwards and options markets. The Forex market is considered the largest and most liquid market in the world. Understanding spot exchange rates. So the spot exchange rate is best thought as of how much you need to pay in one currency to buy another at any moment in time. Spot rates are usually set through the global foreign exchange market, where currency traders, institutions and countries clear transactions and trades. So the Forex market is the largest and most liquid market in the world, with trillions of dollars changing hands daily. The most actively traded currencies are the USD, the Euro, the JPY and the GBP and the Chinese RMB. The euro is used in many continental European countries including Germany, France and Italy. Global Forex trading takes place electronically between large multinational banks, corporations, mutual funds, hedge funds, insurance companies and government entities. Transactions are made for a wide range of purposes, including import and export payments, short and long-term investments, loans and speculation. Economists, analysts and investors can determine the health and well-being of a nation's economy by analysing the spot exchange rate of its currency. Strong spot rates point to a healthy economy, while weak rates may indicate of economic troubles. Strong spot rates equals healthy economy, while weak rates may be indicative of economic troubles. Weak spot rates equals economic troubles. Important. Some currencies, especially those in developing economies, are controlled by governments that set the spot exchange rate. For instance, the central government of China has a currency peg policy that sets the yuan and keeps it within a tight trading range against the USD. Special considerations. The foreign exchange spot market can be very volatile. In the short term, rates are often driven by news, speculation, and technical trading. In the long term, rates are generally driven by a combination of national economic fundamentals and interest rate differentials. In the short term, spot rates can be driven by news, speculation, and technical trading. In the long term, spot rates can be driven by national economic fundamentals and interest rate differentials. Central banks may intervene to smooth the market, either by buying or selling the local currency or by adjusting interest rates. Countries with large foreign currencies reserves are much better positioned to influence their domestic currency's spot exchange rate. So central banks may intervene to smooth the market by buying or selling the local currency or by adjusting the interest rates. Countries with large foreign currency reserves are much better positioned to be influenced. Countries with large foreign currency reserves are much better positioned to influence their domestic currency spot exchange rate. They're much better to. Countries with large foreign currency reserves are much better positioned to influence their domestic currency's spot exchange rate. Spot exchange rate transactions. The settlement date for most spot exchange rate transactions is 2 business days after the transaction date. The most common exception to the rule is a US dollar versus a CAD transaction, which settles on the next business day. Weekends and holidays mean that 2 business days are often far more than 2 calendar days, especially during the various holiday seasons around the world. Speculators often buy and sell multiple times for the same settlement date. In which case the transactions are netted and only the gain or losses is settled. Currency is never meant to be delivered. How to execute a spot exchange rate transaction. There are different ways in which traders and investors can execute a spot Forex transaction. The exchange can be made directly between 2 parties, eliminating the need for a third party. Traders can use electronic brokering systems for automated order matching. Traders can also use electronic single or multi-bank trading systems. Trades can be made by voice over the phone with a foreign exchange intermediary. On the transaction date, the 2 parties involved are in the transaction agree on the amount of currency A that will be exchanged for currency B. They also agree on the rate of exchange. Finally, the parties also agree on the value of the transaction in both the currencies and the settlement date. If the currencies are to be delivered, the parties also exchange bank information. Fast facts. A New York Fed survey found that the North American Forex market's average daily trading volume for all Forex instruments, including spot, forwards, swaps, and options, was 1.021 trillion in October 2023. The USD MXN and GBP USD currency pairs show the largest increase in trading volume since April 2023 according to the survey. Spot exchange rate versus real effective exchange rate. Spot exchange rates are different from real effective exchange rates. While the spot rate is a market rate at any given point in time, the real effective exchange rate indicates the value of a currency relative to its trading partners. As such, it is the weighted average of a country's currency related to a basket of other currencies. Unlike the spot rate, which is regulated by the Forex market, the real effective exchange rate is heavily influenced by central bank policies. Other than monetary policy, several other factors can influence a currency's real effective exchange rate, such as international trade, geopolitics, political risk, the state of the economy including inflationary pressures and recessions, current account deficits, stock market and speculation. The real effective exchange rate indicates the value of a currency relative to its trading partners. As such, it is the weighted average of a country's currency related to a basket of other currencies. Where would we see this real effective exchange rates? The real effective exchange rate indicates the value of a currency relative to its trading partners. As such, it is the weighted average of a country's currency related to a basket of other currencies. It is the weighted average of a country's currency related to a basket of other currencies. The real effective exchange rate is heavily influenced by central bank policies. The real effective exchange rate is heavily influenced by central bank policies. Other than monetary policy, several other factors can affect a currency's real effective exchange rate, such as international trade, geopolitical/political risk, the state of the economy including inflationary pressures and recessions, the state of the economy including inflationary pressures and recessions, current account deficits, the stock market, and speculation. What is the spot exchange rate? The spot exchange rate is the price set by the Forex market at which you can buy a currency today. Think of it as buying on the spot. The settlement date for your transaction will take place 2 business days later for the majority of your currencies. What's the difference between spot and forward exchange rates? Spot exchange rates represent the immediate exchange rate between 2 currencies. As such, it represents the rate at which one currency can be purchased using another on the spot. A forward exchange rate, though, is the rate used to settle a currency exchange at a future date. What do I pay when I need euros for a trip? You pay the spot price as well as related fees potentially. It's a price available at the time you get that currency from a Forex dealer if in your town or order it through your bank. The spot price changes all the time because the currency exchanges constantly change. Because the currency exchange rates constantly change. Bottom line, exchange rate is the rate at which one currency can be changed for another. Rates vary based on who is using them and why. Spot exchange rates are used for various reasons, including foreign investment and international and commercial trades. Foreign exchange investors also use spot rates when they make speculative trades to boost their profits. Can also be used to determine the well-being of a nation's economy. Strong rates indicate a healthy economy. Cool. Next up, currency forwards. So, what is a currency forward? A currency forward is a binding contract in which the current foreign exchange market that locks in the exchange rate for the purchase or sale of a currency on a future date. In the foreign exchange market that locks in the exchange rate for a purchase or sale of a currency on a future date. Currency forward is essentially a customizable hedging tool that does not involve an upfront margin payment. A currency forward is a binding, so it's a mandatory. No, not mandatory, is it? You have the obligation. Is that mandatory? Is that the right word for it? Contract in the foreign exchange market that locks in the exchange rate for the purchase or sale of a currency on a future date. Currency forward is essentially a customizable hedging tool that does not involve an upfront margin payment. The other major benefit of a currency forward is that its terms are not standardized and can be tailored to a particular amount and for any maturity or delivery period, unlike exchange traded currency futures, ETFs. Key takeaways. Currency forwards are over-the-counter contracts traded in Forex markets that lock in an exchange rate for a currency pair. They are generally used for hedging and can have customized terms, such as a particular notional amount or delivery periods. Unlike listed currency futures and options contracts, currency forwards do not require upfront payments when used by large corporations and banks. Determining a currency forward rate depends on interest rate differentials for the currency pair in question. Currency forwards lock in the exchange rate for the purchase or sale of a currency on a future date. Understanding currency forwards. Unlike other hedging mechanisms such as currency futures and options contracts, which require an upfront payment for margin requirements and premium payments, respectively, currency forwards typically do not require an upfront payment when used by large corporations and banks. Is that only for large corporations and banks? So if a retail trader were to use it, do they still not require an upfront payment? Currency forwards typically do not require an upfront payment when used by large corporations and banks. Large corporations and banks. However, a currency forward has little flexibility and represents a binding obligation. Currency forward has little flexibility and represents a binding obligation. So you have to represent a binding obligation, which means that the contract buyer or seller cannot walk away if the locked-in rate eventually proves to be adverse. Therefore, to compensate for the risk of non-delivery or non-settlement, financial institutions that deal in currency forwards may require a deposit from retail investors or smaller firms with whom they do not have a business relationship. Right, okay. Therefore, to compensate from the risk of non-delivery or non-settlement, financial institutions that deal in currency forwards may require a deposit from retail investors or smaller firms with whom they do not have a business relationship. Currency forward settlement can either be on a cash or delivery basis, provided that the option is mutually acceptable and has been specified beforehand in the contract. Currency forwards are over-the-counter instruments as they do not trade on centralized exchange and also known as outright forwards. Currency forward settlement can either be on cash or delivery basis, provided the option is mutually acceptable and has been specified beforehand in the contract. Currency forwards, right. Importers and exporters generally use currency forwards to hedge against fluctuations in exchange rates. And exporters generally use currency forwards to hedge against fluctuations in exchange rates. Example of a currency forward. The mechanisms for computing a currency forward rate is straightforward and depends on interest rate differentials for the currency pair, assuming both currencies are freely traded on the Forex markets. The mechanisms for computing a currency forward rate depends on the interest rate differentials for the currency pair. Assuming both currencies are freely traded on the Forex market. For example, assume a current spot rate for the CAD or for the Canadian dollar of US $1 equals C 1.05. So it takes 1.05 CAD for 1 USD. A 1 year interest rate for CAD is 3%, and the 1 year interest rate of USD is 1.5%. After 1 year, based on the interest rate parity, 1 USD plus interest at 1.5% will be equivalent of 1.05 plus interest at 3%, meaning $1 times by 1 plus 0.015 is equal to 1.05 CAD times by 1 plus 0.03. So 1 USD is equal to, or 1.015 USD equal to 1.0815 CAD. Simplify that, 1 USD is equal to 1.0655 CAD. The 1 year forward rate in this instance is thus 1 USD is equal to 1.0655 CAD. Note that because the CAD has a higher interest rate than the USD, it trades at a forward discount to the greenback. As well, the actual spot rate of the CAD 1 year from now has no correlation on the 1 year forward rate at present. The currency forward rate is merely based on the interest rate differentials and does not incorporate investors' expectations of where the actual exchange rate may be in the future. I'm going to leave this episode here then. In the next video, we're going to carry on from here with currency forwards and hedging. Bye bye.